Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by David Broomfield. Hello, David. How are you?
Hello, I am good, thanks, Sarah. How are you?
Good. I'm well, thank you. So before we get to this week's topic, our new regular, quickfire numbers round, number crunching, we're still arguing about what we're going to call it. But before we get to the main topic, what's your number?
Well, I like esoteric numbers that are sort of way off-piste and random or incongruous even to our podcast topic. But today, this one is very relevant to the topic. Okay. So it is 200 million.
200 million.
Okay. 200 million, I'll tell you, is the number of people that China's labor force would increase by if the retirement age was raised to 65. Currently, the retirement age is 50 for women, 60 for men. If they raise the retirement age to 65, that's an extra 200 million people into the labor force instantly. Wow. So there's a cracking chart in the FT that I lifted that from. And we're going to talk a lot about China and that context today, I think.
We are. Well, my number has got nothing to do with this week's topic, but it has got something to do with something I did at the weekend. And it's 117 million.
117 or 70?
117.
117 million. No idea. I wouldn't have an idea if it was 170 either. Tell us what it is.
Well, at the weekend, I went to see the Van Gogh exhibition at the National Gallery, which is fantastic. And it is it's the highest price paid for a Van Gogh painting, which was Orchard with Cypresses, which was sold at Christie's in 2022. And actually, it is a subject we're coming back to because we're going to be talking about investing in luxury. And we've talked about investing in art in previous episodes. We're going to be doing that later on in the year. But funny enough, it is a way off the most expensive painting ever sold at auction. It doesn't even make the top 10.
I feel like you've got that stat at your fingertips to tell me.
I have. It was $450 million that was paid for the Salvator Mundi, which was by Da Vinci, although there's a few question marks about whether it was completely by Da Vinci.
And, and for a bonus point, what year was that? Do you know?
What year was it sold? 2017.
2017, there we are.
Yeah.
I always think these things are quite correlated with economic cycles. So we'll definitely come back to that when we look at art in more detail, shall we?
And certainly Japan used to be a big buyer of some of these really big ticket items. No longer, but that's what they certainly used to be.
Huge buyer. I mean, corporate Japan, the corporate headquarters of all these multinational firms was littered with the finest art that money could buy. You had incredible sculptures and priceless pieces of art littering the reception. So or many of those have been sold back to the market over the decades.
Yeah, I mean, sadly, I don't actually know who bought the Orchard with Cypresses. I'm assuming it's in a private collection somewhere. So unless you can see it in an exhibition, you won't get to see it. Anyway, okay, back to the main topic. Obviously, it's to do with China. We've talked about the US recently. We've talked about Europe in last week's episode, Mario Draghi's report. So we're kind of going around the world and we're going to be focusing on, China predominantly, but emerging markets as well, aren't we? So what are the three topics we're going to cover?
So you're absolutely right. The three topics are all under the banner of emerging markets. I think it's only fitting that as we come to the end of this rate hiking cycle, and now it's rate cuts that everyone's debating how many and by when, that we go back and just look a little bit at the fallout on emerging markets that the rate cycle has levied. So that it's caused a lot of stress in emerging markets and a lot of stress actually across the whole financial system. So we'll talk a little bit about the rate hiking cycle. Then let's look at EM performance, shall we? Let's look at the winners and the losers, because there's been some remarkable stories this year, and I'd like to pluck a few of those out before we really drill down and look at the third thing, which is China, the growth problem, the policy conundrum, and some of those structural issues that are facing China. China, obviously, a massive component of emerging market indices. So we've talked about this a lot this year. We've talked about it in a podcast, I think, in March. We've talked about it in many of our Coutts.com articles. Yeah. It's quite an important topic. So let's get into those structural issues.
Yeah, okay. Well, let's kick off then with the impact of tighter monetary policy. Why does what the Fed does impact other countries? What's that got to do with China or Taiwan or Indonesia or other emerging markets?
Well, you've heard me talk a lot about the Fed, how it's the global central bank, and how many other Western central banks are somewhat proxies for the Fed. This idea of these dollar swap lines and actually how policy is transmitted. But In the case of emerging markets, it's slightly different. It's not the case that they're hardwired and interlinked to the Fed, but in many cases, they actually follow the Fed. They have either pegged exchange rates or they just hardwire their monetary policy into what the US monetary policy position is at any period in time. So this current rate hiking cycle, the one that started in March 2022, just for context here, this has been the most aggressive cycle in recent times. Okay, it's certainly when you compare that to other rate hiking cycles. So we had magnitude of hikes that was really high. If you go past your mind back only a couple of years to 2022, you had the Fed issuing multiple 0.75% hikes in quick succession, and then that's nothing. Sorry, that's something we haven't seen since the early 1980s. So we had around 500 basis points, 5% of hikes from the Fed in a single year. Compare that to 2015, Incredible. 2018, where we had 2.25% of hikes in 3 years, or 2004 to 2006, where you had around 4.25% of hikes over 2 years. This, you had 500 basis points, 5% of hikes in 1 year. So it was big, it was fast. And yes, we've avoided any sort of financial crisis from that, but make no mistake, we've put the system under a lot of pressure. That was felt in the US mini banking crisis, and I suppose you can make an argument perhaps by the massive Credit Suisse issue as well. But what the financial sector told us implicitly was that we learned all those lessons from the GFC, from the global financial crisis. Regulation, capital requirements, the system worked, okay? So there's been little fallout in the Western financial system. But if we look into emerging markets, they have been under a lot of pressure. So those rising interest rates in the US and Europe, they've triggered quite a lot of financial distress. So if you take a cursory look, so start with, okay, where does the money go to? So follow the money. If you look at capital flows, you can see that emerging markets saw a massive surge in outward capital flows. In that period of 2022, you saw about 50 billion in capital outflows from emerging markets alone. That's IMF data.
Okay. Is some of that down to the fact that, because when we talked about the US and the dominance of the US, and we talked about the fact that commodities are sold in dollars. So is that why the rate that's set by the Fed and the value of the dollar is so critical for these emerging market economies, because they're having to buy oil or copper or whatever, and they're having to pay for it in dollars?
So there are two stories here. There's that story, if you're an emerging market that imports a dollar-based commodity, where you've just experienced directly imported inflation. But there's a more complex story if you're a commodity exporter that pegs your exchange rate to the US dollar. I'll come on to that in a minute, because that's quite critical, actually. But the capital flows, the 50 billion in initial outflows that you saw in that sort of early 2022 period, was basically investors just seeking yield.
Yeah, that so was I was going to say, like the yen carry trade, essentially.
But the principal issue isn't really that. It's that you've got these countries like Argentina, Turkey, South Africa that are burdened with this massive pile of dollar-denominated debt. That becomes instantly more expensive as rates rise, and then the dollar strengthens. It's like a double whammy. So if you look at Bank of International Settlements data from last year, 2023, you can see emerging markets hold about $3.7 trillion worth of dollar-denominated debt. So they're very, very sensitive, vulnerable to exchange rate fluctuations. So you've got this trifecta almost of rising dollar, imported inflation, and then some EM central banks, they've had to aggressively raise rates, hike rates to combat inflation. So look at Brazil for that example. You've had an aggressive rate hiking cycle, so rates over sort of 13.75% to combat inflation. So, and defend its currency. So, you can see that move mirrored in many countries, and you end up with this situation where you have sort of deteriorating local economic conditions as a consequence.
I mean, if we talking about sort of pegging, in Argentina, the reason why they pegged to the dollar was to stop hyperinflation, wasn't it? So it seems that by actually, you've kind of done one thing to stop hyperinflation, but you've ended up with inflation anyway.
Yeah, the Argentina story is ever so slightly different. There's a bit of nuance there with what's happened politically and domestically, but it is worse if you pegged against the dollar. And you're right, many emerging market currencies do that. They do it to remove the currency volatility. It creates instant credibility because you're effectively taking the Fed's economic credibility implicitly, and that builds investor confidence. Because you're an explicit taker of US monetary policy, you take whatever decision the Fed makes, like it or not. I mean, I'll go even further. So this point I made earlier, it's even worse if you're a commodity producer, because as the price of the commodities goes up, which is, by the way, what we saw during that period in 2022 and onwards, you end up increasing your domestic foreign exchange reserves, right? So you're selling all this stuff in dollars, the price of it goes up, you accumulate all these foreign exchange reserves, but the exchange rate's pegged. Naturally, the exchange rate would adjust to kind of counteract that effect, but it can't because you're pegged against the dollar. So what the central bank does is it issues more domestic currency to keep the peg aligned, and then boom, what do you get? Inflation.
Yeah.
So you've had this, as I said, this sort of trifecta of problems hitting emerging markets. China, I'll dwell on for a bit because it's in a bit of a unique position amongst many emerging markets because it's been insulated to an extent from these global rate hikes because it has these very controlled capital markets. It has a lot of domestic savings, and but the country's faced declining export volumes. Okay, so at the same time, China's exports have been shrinking, and 2023 saw one of the sharpest drops since the pandemic in that respect. So you've had global monetary tightening, this effect of the rate hiking cycle, slowing consumption in the major export markets, and then what you're doing in China is you're when you look at it at 30,000 feet, you're seeing this massive trade surplus of around $877 billion. That almost masks what's going on here. You think they're exporting loads, but you're actually not. You're masking this sort of underlying weakness in domestic demand. And let's talk a lot about that in the third point, because I think that's really, really important. So I'm going to just conclude on one point with China, which relates back to our conversation earlier in gold. If you're in China, if you're in that emerging market, how do you preserve the real value of your wealth? Well, remember, the government wants to keep the exchange rate weak to boost export competitiveness, but then externally, you've seen the dollar appreciate and yield strengthening. If you're in China, you generally find that very difficult to access due to capital controls, but you can generally buy gold.
Yeah.
So one of the reasons we've seen such massive demand for gold coming from China is because of, the second order, third order effects. It's because of how the global rate hiking cycle has played out.
Okay. So we've discussed the fact that Fed policy has obviously had an impact on emerging markets because of how closely allied they are to the dollar, whether they're actually pegged or whether it's because they're trading in dollars. Does it then follow that we're now at the beginning of a Fed rate cutting cycle? That should be good for emerging markets.
It should be. Obviously, all those problems that I just mentioned then sort of flip on their head to an extent. China, which we're talking about a lot today, has already been considering rate cuts for some time to try and stimulate the economy. And remember the history here. We've talked about this before, just how much of the Chinese economic growth story has been based around property and loans against property. Equally, the corporate debt market in China is massive, 160% of GDP. So, Chinese policymakers are acutely aware of defaults. They've been ahead considering rate cuts. But yes, once the Western world goes through this cutting cycle, particularly in the US and Europe, it does alleviate some pressure. Dollar strength, generally, if you look back at history, causes emerging markets to underperform. But on the other hand, more recently, and by more recently, I mean today compared to previous decades, the capital structures of emerging markets are better than they were in terms of how that debt is being structured and how sensitive they are to floating rates, and particularly rates in the US. But what you would expect now is some of that pain, some of that pressure to be relieved in emerging markets to find it easier, yes.
Yeah, and certainly I know we've discussed when we had Monique and Joe on, I asked the question of, as you just described, the rate hiking cycle was extremely aggressive. the cutting cycle is probably not going to be as aggressive as it. It's going to be much slower coming down than it was going up.
Yeah, and we won't get into the weeds there because we've talked about it a lot. Yeah. But remember my little pithy summary of that. That chaos arrives quickly and tends to leave slowly. So the only reason we would see a very quick cutting cycle is if the economic conditions deteriorated to such an extent that it would warrant it. And there is nothing on the horizon that would suggest that that's going to happen, not anytime soon.
Okay, all right then. Well, let's come then, before we get to our third point, which is where we're going to focus on China. Let's look at the sort of wider emerging market sort of sector, and perhaps some of the winners and losers. Who's kind of doing well? Who's getting it right? Who's perhaps not getting it quite so right?
Yeah. So the point I just alluded to a moment ago. Look at the fundamentals of emerging markets. They've actually shown stronger fundamentals than probably what they did a decade ago. Okay, they've got improved current account balances, less dollar-denominated debt. I mean, that number is still big, but it's less than it was a couple of decades ago. And they've got greater foreign exchange reserves that gives them some buffer and some ability to be able to withstand economic shocks. And that's helped them to an extent, but emerging markets have had quite a mixed performance, certainly in 2022 and 2023. Yeah, and that's been influenced by various global factors. So you've seen this divergence of performance, right, between emerging markets and developed markets. If you go back to 2022, you'll see that emerging markets fell almost on a par with world markets. So if you look at the MSCI Emerging Markets Index in dollar terms, it was down about 20% in 2022. We all know why that was: the asymmetric shocks, the rate hiking cycle. And then if you look at developed markets, the All Countries World Index, that was down about 18%. So about the same amount. But then go into 2023, when we obviously saw this big rebound, you had emerging markets only up around 9.8%, but the All Countries World Index up 22%. Yeah. So clearly it has been lagging. China is definitely part of that story. You've had this obviously, depressed potential, and you've had, the policy grappling with how do we generate growth and stimulus. So, China's a big component of that index, and it's been lagging.
Yeah, that's what I was going to ask you. I was going to say, what percentage of that index is made up by China?
Oh, I'll have to check, but I think off the top of my head, it's around 20%. It's quite material. Yeah. So we'll fact check that perhaps after the podcast. The point though is that China has struggled. So you asked what are the top performers and what are the bottom performers. Well, let's start with the negatives first. It's been China, and if you look at whether it's the Shanghai A or B or even the CSI 300, you see a similar pattern. I mean, year to date, you've got the A and B shares down by, the A shares are down about 23.5% year to date. So it's material, absolutely material, and it's because of these multiple headwinds: slowing economy, regulatory crackdowns, the real estate crisis, which the Chinese purposely deflated, but it's obviously been such a big component of GDP. The hangover is really acute here. So you've had those companies like Evergrande, you've had the geopolitical tensions with the US, lingering effects from the strict COVID policies that we had a few years ago. You've had all these things have dampened investor sentiment. So no wonder the Chinese markets have been under so much pressure. Equally, if we look more broadly, let's not get too hung up on China, look more broadly into emerging markets. Brazil has had a dreadful year, down around 16, 17%. It's been impacted by high inflation, high interest rates. I mentioned the Brazilian central bank has had interest rates very high and kept them. They were one of the first central banks to move, and they've kept rates extremely high. And then you've had political uncertainty as well. So that all relates back to fiscal policy, which has had a bearing on the currency. So problems is the short summary. Meanwhile, the winners, by contrast, and we talked about this in the earlier podcast this year, we were way ahead on this story. India has had an incredible year. Strong domestic demand, which is something we'll come on to when we talk about China. Solid corporate earnings, pro-growth government reforms, this idea of how do we increase productivity. A lot of direction from the Indian central government to try and do that. So post-COVID, India, by contrast to China, has massively outpaced expectations. And that's been driven by some leading sectors as well, IT, finance. And I think, although the FDI data, as I've previously discussed, is a little bit ambiguous here, anecdotally, India is emerging as an alternative to China in global supply chains. So it's not quite straightforward, because India, from a geopolitical point of view, is aligned on some levels and not aligned on others. But there does appear to be substantial foreign investment currently going into India. So India, standout performer in emerging markets. And then, of course, I'll just conclude with probably Argentina. If you go on to Bloomberg or any data provider and look at Argentina's performance year to date, you'll see a quite astounding number, above 90% year to date. But that's complicated. That's been driven due to hyperinflation and generally inflated asset prices. And as the currency is depreciated, you've seen this almost artificial elevation of returns if you're a foreign investor, obviously less compelling if you're a domestic investor. Currency devaluation plays a massive role here, when basically inflationary pressures just drive up the nominal value of the market.
Yeah. Okay. So thinking about the countries that have done less well, and you've talked before about this trend for deglobalization. How much of that has impacted emerging markets? Have they been the losers in that sort of conundrum?
I think from a sector standpoint, they've been winners, right? Because friendshoring and well, that perhaps is too bold a state. I think there are individual country stories that have benefited from deglobalization and increasing resilience in supply chains. I'll give you a classic example: Mexico. Many Chinese manufacturers have built at least a presence or some component of their production line in Mexico for a couple of reasons: to try and work around this increasing geopolitical tension bilaterally between the US and China, and then also immediately passport into the trading agreements between Mexico, America, and Canada. You've seen that in a number of countries as well. You've seen that by a number of other countries increasing their presence in Mexico. But this idea of friendshoring as well is really important. So some emerging markets have benefited due to their more constructive, let's say, geopolitical foreign policies than just simply having factors of production located in China. So it's a complicated story, but deglobalization definitely has played a role. But remember, that's the kind of narrative here that's operating at a sector level. At a macro level, it is still that hangover, as I said, from the rate hiking cycle and from this large pile of dollar-denominated debt that has just dragged on the economy.
Okay. And I did see a figure somewhere that global inflows into emerging market funds since January are down 30% on the same time last year. Now, presumably that's a reflection of the fact that those countries have struggled a little bit under current Fed policy, and that should then start to improve as interest rates start to come down and people start to see the region. It's not a region, is it? It's a group of countries, sort of loosely under the heading of emerging markets, should start to improve. I mean, I still find it odd that China is an emerging market.
Yeah, I think you're right, because there are obviously parts of the Chinese economy that don't resemble emerging markets at all. If you look at it on an income per capita basis, I think that's probably why you get to that example. You've still got a large rural population, although obviously it's massively been migrating into urban centers over the last few decades. You're not on an income per capita basis anywhere close to the United States right now. So I think that as the dollar weakens, you can perhaps make a slightly more positive case from emerging markets. But we've got a different world than we had a decade and a half ago. And I've talked about this obviously on the pod quite a lot, about how the story of globalization and benign geopolitics isn't the same. We have a different world now where, as I said, people are looking at emerging markets through a slightly different lens. So the importance, as we'll get to when we talk in the third section about China's structural problems, I think investors are looking now at the governance, at the geopolitics, at the ability of these countries to generate robust sort of domestic demand, and also the dependence on commodities, because all of these things otherwise are quite cyclical, quite fickle. It's all very well owning commodity exporters if you're in a commodity super cycle with the dollar in your favor, but if that's not the case, then it can be quite a painful trade. So I think that there's a renewed focus on what is actually driving underlying economic growth, because that old model of just keeping your exchange rate weak and exporting to the world, I'm not sure is that attractive to investors anymore.
Okay. Well, let's come to China then. We've talked about some of the winners in EM, and we've talked about the fact that China, which makes up the lion's share of that collection of countries. What are the challenges? I mean, we've already alluded to some of them, but let's focus then on what are the challenges faced by China?
Yeah, we'll talk about a few things. We'll talk about some of the structural challenges, some of the, frankly, political challenges, and also, there's this massive demographic problem that is just looming large in the background. But China has got all the symptoms of a balance sheet recession. It's got this protracted period of deflation, property market declines, and this big debt burden. So at first glance, it's very easy, I think, to say, wow, that parallels with Japan. So let's look at that story. But it's more nuanced than that. I've talked a lot about the structural issue with China, that you've got this massive current account surplus, an extremely high domestic savings rate. That floods the domestic economy with excess liquidity, but you don't have enough domestic demand to absorb it. And so what you saw over the last decade, well, before the Chinese purposely pricked the bubble, was China's banks ended up directing huge sums into fueling this massive property market bubble.
Yeah.
And those gigantic property projects, that accounted for about a quarter of economic activity. So that there are some big structural problems. So the challenges, which was your question, you've got this economic slowdown, which has slowed significantly, partly due to the effects of the zero COVID policy. That was, that brought the economy to a halt in 2020 to 2022. And there's not been this robust recovery since. You've got the housing market, which I just mentioned, it's in crisis. And then you've got the decline of exports. You've had this export-driven growth model, and exports have fallen from their historic highs in 2022. They've just fallen off a cliff. And it's about weak domestic demand. Yeah.
Why aren't the Chinese investing in their own stock market? Because that's another issue for the Chinese economy, isn't it?
Yeah, I think this is there are a lot of factors here. I think it's somewhat cultural, and there is definitely has been a dream in China to own your own property, and I think people have viewed that as the pathway to wealth creation, versus being an equity investor. There is also, I think, the uncertainty of governance, perhaps, because as I've mentioned before, the government is a significant operator within the equity markets as well. The nature of the companies you get exposure to, and also let's look at the numbers, look at the returns. I think it's tricky when you compare like the CSI 300 to other global indices to make a compelling case to be a long-term investor when there's just been better earnings growth and better shareholder reward in other regions. So I suppose I don't know is the answer. I suspect it's a combination of cultural factors, economic factors, regulatory factors as well. So you've had lots of challenges. The economic slowdown, housing crisis, decline in export. You've got this demographic problem that is looming behind you as well. I mentioned, obviously, in my number this week that you would increase the Chinese working age population by about 200 million if you raise the retirement age. You've got some regions in China that have around 40% of their population over the age of 60. So the economic impact of that is now really starting to bite. And you're seeing labor shortages in some regions. That affects productivity. So there's a lot of strain in the domestic economy, and many academics, many policy commentators are saying that the Chinese need to seriously entertain structural reforms to address some of these issues. This export-driven growth model, cheap exchange rates, and just manufacturing things and exporting to the world isn't going to now see China through to its next stage of economic development. So let me just bring that to life with a statistic. By the end of the century, China could just have one worker for every retiree compared to 4 today. Okay,
Wow.
so
Okay.
4 workers per retiree today, it could just have 1-to-1 by the end of the century. So this demographic problem looms large. Let me give you my take on this. Well, let me give you my summary of where I think the debate fissure lies. You've got, I think, 2 groups of commentators when it comes to China and I think they're both right, but one looks at China's symptoms and says there's a political interpretation for that. So they're saying there's this sort of authoritarian region where the regime has constrained the economy so much, and this is backed up by data that says that business confidence has been impacted, that private investment has been impacted. And when you look at the Chinese economy, you see that about 50% of tax revenues and 60% of economic output and about 80% of urban employment come from the private sector. So Beijing has been very heavy-handed post-COVID in the private sector. So some people are saying that that's the problem.
Yeah, I saw a number that the decline in venture capital in China. In 2018, there were more than 51,000 startups. In 2023, there were just over 1,000.
Yeah, so you've seen the effect acutely in data, right? I mean, I think that let's contrast that, heavy-handed governmental interventionist approach with the other explanation, which is more about a structural problem with China's economy. And that's the one that I mentioned just a moment ago. You've got these big macroeconomic imbalances. So the Chinese economic growth model is being heavily reliant on basically investment and financial repression. So the property market bubble that I mentioned. And that's the core issue, that household consumption is low. And that's a statement relative to GDP. And it's surprisingly low compared to other emerging markets. And that's, I think, the side of the debate I lean to more heavily. You go back and look at history here. China's economic problems didn't start with an authoritarian interventionist approach in markets post-COVID. They started way before that. The global imbalance of savings and investments between China and the rest of the world has been noted for about 3 decades now. So I think it's both of these things, not just one. I think that the Chinese government has obviously been very confident in its ability to manage the economy post-COVID. But there's been some quite bold moves of cracking down on the tech sector, suppressing various education firms, and I think that acts as a disincentive to private sector capital. So there's a global implication here, because China's challenges are linked to these global imbalances, as I say, this trade surplus. So you can't fully understand the problem in China without considering its reliance on global markets, and especially the US, right? So the US has been the kind of world's consumer of last resort. So you need to look at it within that context. I'm not sure it can be solved just in isolation. I think you need reforms in both the China and the US to lead to a more sustainable growth model.
Yeah, I mean, China's got to increase domestic demand, hasn't it? Essentially, and sort of wean Chinese investors off property, which I guess has kind of happened. Now they're putting their money into savings, or they're putting it into gold, but allow startups to flourish again, allow the private sector to flourish again, so that there's a little bit more sort of energy and a little bit more momentum in the Chinese economy, I guess.
Yeah, I mean, and all that comes, let me be frank, that comes at a political cost. Okay, so the Chinese version of communism is unique, but I would say that there is a concern with creating a wealthy, powerful middle class consumer, because that then creates potentially challenges for the regime. So I think that if you think about that version of communism, it's one where it's very pro-Lenin in terms of its concentration of power. but not so pro-Marx in terms of its redistribution of wealth. So that would need to change, I think, to create an emergent domestic market driven by a middle-class consumer. These things are all interlinked. You can't solve them in isolation. The politics, the domestic market, and its relation with the US consumer as well. They're all interlinked.
Yeah, I was going to say, and also they do need to attract foreign direct investment, don't they? Which has declined, certainly in the first half of this year, 29% year on year. And they need that as well as the domestic demand, don't they?
Yeah, exactly. And I think the foreign direct investment story, again, is an interesting one. Earlier in the year when we did the pod on this, I suggested looking at the chart of foreign direct investment. And you can see that the Chinese FDI has fallen off a cliff.
Yeah.
Now, some of that will be because of geopolitical tensions.
Yeah.
But not all of it. No. Not all of it. And I think you need both. You're absolutely right.
Okay. So going back to the sort of start of our discussion, when we talked about the reason we were talking about emerging markets was partly because of the sort of tight monetary policy we've seen from the Fed and how that's impacted. We've said that really that hasn't really been a key factor in China's current situation and their current sort of lackluster performance. So when we're saying then that the Fed rate cutting cycle is not really going to have an impact on China, what China needs to do is there's a number of issues they need to address themselves with domestic demand, with perhaps making the market more attractive for foreign direct investment, and generally making it an economy that can be more open, more startups, more sort of less moving away from property, moving away from savings, and get that demand up. And that's not going to have anything, that's not going to be impacted by what the Fed does.
Yeah, well, look, the Fed will have an impact to an extent, because as much as the Fed drives the global consumption or global economic cycle, and China is today still a principal exporter into that cycle, yes, you know, the global economic conditions do impact China, but also, you know, China does impact the global economic conditions. So I think, though, that just putting it simply, it's about the economic model for China. Is it just going to be an export-driven model where you have a cheap exchange rate and you export goods to the world, or is there going to be domestic demand? Now, the impact of the dollar and the impact on the rate cycle certainly helps the former economic model, but it won't solve problems. The problems I've just presented and put to you about the demographic challenges, the challenges of switching domestic demand and investment away from property into different markets, they won't be solved by actions of the Fed. They need to be solved structurally by reforms of China's domestic economy.
And coming back to the episode we did when America sneezes, if China is going to seriously challenge America as the world's largest economy, they'll need to look at making those reforms, won't they?
Yes, exactly. I mean, we talked about this a little bit the other week about the measurement problem of what defines the largest economy, because obviously how you measure things, you get slightly different answers, whether you do it in dollars or electricity consumption. And I think people are too hung up on that idea, actually, that you know, which country is bigger. I mean, you know, India, by some respects, is now overtaking China, depending on how you measure it. Yeah. So you've got the potential there for a massive market, massive global market, massive consumer market. Yeah. And I think that's the important point. But the clock's ticking, because demography, as I said, by the end of the century in China is going to look markedly different. And we talked a little bit last week about how it's going to look different in Europe, the UK, but in China, because of the one-child policy, it looks so much worse.
Yeah. Okay. On that happy note, a reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Thank you for listening. Thank you, David. If you don't already, make sure you subscribe to Need to Know. You can listen to previous episodes. Last week's is Europe, the sick man of Europe, where David very kindly for us read Draghi's 400-page report on basically how Europe can be more competitive.
A bit of light reading.
A bit of light reading. So he did us all a huge favour. But anyway, and the previous episodes we've discussed, and the one where we looked at the US economy and why the US economy is still the most dominant, whether it's the largest, depending on what metric you use, but it's certainly the most dominant global economy. Until next time on Need to Know, bye for now.